Hi, everyone. This is November 11th, 2021, and we are going to be talking about Wall Street secrets. Now, you may have heard a lot of Wall Street secrets like don't fight the Fed or bulls make money, bears make money, pigs get slaughtered. You may not have heard some of the Wall Street secrets that we're going to be talking about in today's video conference. And they're pretty relevant in today's world. So I do encourage you to stick around. I'll be right with you. And as always, with lots of food for thought, as well as data to back it up. All right, we'll see you in just a few moments.
So hello again. And again, it's November 11th, 2021. And today we're going to be talking about Wall Street secrets. And as I said, there are many that you may think you already know. Bulls make money, bears make money, pigs get slaughtered. Don't fight the Fed. There's probably a slew of them that you know. But chances are there are a few of them that we're going to go over today that you are not aware of. And they are very relevant. So I'm going to share the screen and go through a few of them with you. And of course, I'll be chiming in for color as we go along here. Okay, so just as a reminder, the ABCs of Money, 5th edition, and Put Your Money Where Your Heart Is, 2nd edition, have just been released. They are completely updated and relevant, and I highly recommend that you read them. So these are some of the Wall Street aphorisms that you may already know. Don't reach for yield. Never confuse a bull market with wisdom. Bulls make money, bears make money, pigs get slaughtered. This may be one that you don't know. The higher the dividend, the higher the risk, which goes hand in hand with don't reach for yield, right? The CEO is the soul of the company. This could have helped you tremendously back when Nicola was getting a lot of airtime on CNBC. And now that particular CEO is under investigation and has been charged with fraud. The spring and Santa rallies, you could have seen it in his CV that, he probably was going to have difficulty taking on Tesla. The spring and Santa rallies. So these are pretty good most of the time. There are certainly times when the spring and Santa rally aren't that good. As an example, March of 2020, the spring rally wasn't that great. Also in December of 2018, we saw the worst December that we've seen since the Great Depression. So it's pretty important not to just try to ride the seasonal trends, although you do want to know them. A rising tide lifts all ships, and that's what's really been happening for a while in conjunction with Don't Fight the Fed, is that we have seen stocks go up and it lifts up a lot of stocks, some of them not as great as other ones. But there is a trend happening that you might not be aware of that we want to definitely talk to you about as well. And here's some more of the ones that you might already be aware of. Large caps for stability, small caps for performance. And we already talked about Don't Fight the Fed. So are you aware of some of these timely Wall Street whisperings? Bonds are illiquid and negative yielding. What does that mean? Well, they're losing money and they could be a real big problem because there might not be anybody who wants to buy them from you. A lot of the second opinions that I do, people have bonds that are going to come due in 45 years, and this person might already be in their late 60s. So it's really important for you to know what you own on the safe side too. It's really important to know what you own always on the at-risk side, the equity side, and to be properly diversified. But in today's debt world, it's really important to know what's on the safe side because bonds are illiquid and negative yielding, and money market funds have redemption gates and liquidity fees. What does that mean? It could mean that you don't get access to your money when you want it, or that you might be charged to have access to your money. Value is dead, growth is killing it. You may not be aware of that. Over the last 3 years, the NASDAQ Composite Index has practically tripled the Dow Jones Industrial Average. There are reasons for that, a lot having to do with debt. So we'll talk about that in a minute too. The CAPE ratio is higher today than it was in the Great Depression. Now, many of you might remember that when you were taught about the Great Depression, you were taught that stocks were very speculative. And when they crashed, then we had all these people that were jumping out the windows on Wall Street. Stocks today are more expensive than they were in the Great Depression. We'll show you some charts to back that up for you. Meme stocks have given shoot the moon new meaning. We'll talk about that. But I also have had, shoot the moon stocks video conferences that you can go back and look at for free, where we just talk about that phenomenon. Corporate buybacks have fueled the recovery. Sorry, I want to go back to that. The fastest growing economy, or one of them, is in the European Union and is a tax haven. So which country is that? Take a moment to see if you can think which country that might be. And I want to share with you something that many people are not aware of, but Wall Street is certainly aware of it. And that is that the market tends to follow Apple's share buyback plan. So Apple has been on a buyback tear, about 20 billion per quarter of buying back its own stock. So that pushes up the Dow Jones Industrial Average as well as the NASDAQ Composite Index. So it really has been fueling the Wall Street recovery. There's a lot of other buybacks, a lot of suspension of the buyback program in 2020, and it's starting to come back. So that's good for a Santa rally, as is the 5.7 to 5.9% GDP in the US, about 8-ish% in China. Now, which country in the European Union is higher GDP, and how high is it? Well, let's look at that. So it's projected to have 13% GDP growth in 2021, and that country is Ireland. Interesting, isn't it? Now, Ireland is one of the 9 hot countries that I listed in the 5th edition of the ABCs of Money. There is a chapter called What are the Hottest Countries in the World? There are 9 countries listed, and of those countries, Ireland was upgraded from GDP. I think it was projected at 4%, and bang, it's up to 13. Chile was upgraded to 11%, and Peru has been upgraded to 10%. These are 3 out of those 9 that were listed. So it's really important that you're staying up to date with the hottest countries in the world. Obviously, we mention them at our retreats as well, but you can get the rationale in the ABCs of Money, that special chapter, What are the Hottest Countries in the World? The NASDAQ, as I said, has almost tripled the Dow Jones Industrial Average between 2018 and 2021. Are value stocks dead? Are they really of value? Now, the interesting thing about this is that value stocks have so underperformed growth that Wall Street is trying to redefine the word value. That should tell you something, right? Also, if you think about it, if stocks are at an all-time high, if prices are higher than they were in the Great Depression, and value means on sale, what's on sale? Is anything in the US on sale? Is anything in the world on sale? Let's look at that. So corporate buybacks do explain a lot of the outsized performance of growth. As you can see, Apple has been really killing it in terms of how much they're buying back. In the second quarter, it was 26 billion, and they set a record in the fourth quarter of 2020 at almost 28 billion. Now, low interest rates create asset bubbles. This is a chart of what we call the CAPE ratio. And what the CAPE ratio is a 10-year average of price earnings ratios. And as you can see in this chart, which I already told you, is that today, where we are, that blue line that says 38.3 is higher than it was in 1929 during the Great Depression. So that's pretty important to note, right? And it's the only other time that was higher than it is today was 2000, right before the the dot-com recession. Now, investors are borrowing money, and this is higher by far than any time in recorded history. So it's really important for you to be aware of that the prices are high, and a lot of it is on borrowed time and borrowed money. That has led the Federal Reserve Board, they issue what's called the Financial Stability Report. This is another Wall Street secret, financial stability. So the Federal Reserve Board issues a financial stability report in May and in November. So it should be issued any day now, the updated one. This is from May of this year. And here's what they said at that time. You can read it here. Basically, that should risk appetite decline from elevated levels. In other words, if investors get spooked, a broad range of asset prices could be vulnerable to large and sudden declines and lead to broader stress to the financial system. Now, when he's talking about asset prices, he's talking about things like stocks, bonds, real estate, things of that nature. It could also apply to cryptocurrency, gold, silver, that sort of thing. So here we are, and this is another chart that was put together by the Federal Reserve Board saying, look, this level of escalation is at the same level as it was in 2000. And in 2000, in the dot-com recession, stocks dropped 78% from the high of March of 2000 to the low in October of 2002. Now that means that if you had $1 million, it dropped to $220,000. So this is pretty important to realize that, yes, we're in a bull market. Yes, we've had great gains, especially since March of 2020. But at the same time, it might be a good idea. And yes, we should have a Santa rally, but it's a very good idea for you to start thinking about, when do I do my rebalancing? Do I have enough safe? What's safe in a debt world? So as a reminder, the Dow plunged 55% in the Great Recession. Now, in the dot-com recession, it took 15 years to get back to over 5,000. So you were down for a very long time. In the Great Recession, it took about 7. The S&P lost 38% between February 19th and March 23rd of 2020. Of course, it's back with a vengeance and higher today, much higher. But it is a warning, because the reason that recession was the shortest in history, 2 months only, is because we printed up over $5 trillion. So about 7.8 trillion was added to the public debt under the prior White House, under the prior administration. We can't keep doing that. There's many reasons why we can't keep doing that. So it's unlikely that the next recession, we're going to be able to roll out the printing presses and print up, $8 trillion. So thinking that recessions only last 2 months and all you have to do is buy and hold, that did work 1 out of 3 times in the 21st century. It's very unlikely to work in the next one. So Apple, again, as we've talked about, when Apple buys stocks, it keeps the market pretty buoyant. Now, another thing I want to remind you is that if you wait for the headlines, you are late. Wall Street insiders jumped ship in the first quarter of 2020, starting in January. The all-time high was February 19th, and then the market low is March 23rd. So a lot of them sold pretty high and probably were able to buy pretty low at the low. Also, the S&P 500 lost 9% December of 2018. And again, here's another example of Apple. Apple reduced its share buyback and it had almost no buybacks in December. And the result of that was the worst December that we've seen since the Great Depression. So again, what is Apple going to do this time? Is it going to be continuing that robust buyback program, which fuels the market? Or is it going to stop its buyback program in December like it did in 2018? Well, let's take a look at their forward outlook and what they say about it. They're expecting to have very solid year-over-year revenue growth and to set a new revenue record. That speaks volumes to them pretty much having to continue their buyback program, because the little secret that happened in 2018 is that they were going to have lower than expected sales, and it was actually going to be lower than the prior year. And so with that information and knowing about that information, even though they weren't going to report it until January, they stopped their buyback program during the quiet period. Has a lot to do with SEC compliance. Now, if all of this is a little bit too much for you, please bear with me, because we are going to shoot to the clip notes on what it means for you and what you can do about it, okay? We're almost through all the data-rich stuff. And if you don't understand everything I'm saying, just understand that as you continue speaking the language, you will. And there's probably a lot that you do understand, like never pay retail and stocks are expensive. Liquidity data. So what that means when I say bonds are negative yielding and illiquid is that they are difficult to sell because other people don't want to buy them, and they could be losing money. In fact, a lot of them are, especially when you factor in fees and inflation. So if you're not getting paid to take on the risk and you might have trouble selling it, is it safe? If you're losing money, is it safe? Should it be on the safe side, or should you figure out something that's safer? We spend one full day on what's safe at the retreat. That's how important it is. Now, I wanted to tell you that bonds have been illiquid and negative yielding for quite a while, but so has the Dow Jones Industrial Average. So this is a chart of how easy it was to sell things. And this is from December of 2019, before the pandemic. And as you can see, if you had short-term treasuries or S&P 500 stocks or even gold or the euro, you were US T-bills, you were going to have an easy time selling. If you had Dow Jones stocks or corporate bonds, they were very, very illiquid. And what that means is, let's say you paid $1,000 for it and you really need to sell it for whatever reason, maybe to make a house payment, maybe to make a medical payment. And you try to sell it so that you have some cash or some liquidity. The other person across the table says, I'm not interested in that bond. And you have to say, well, I paid 1,000. Will you give me 800? Right? So you're taking a severe haircut. And if they get more illiquid for any reason at all, like say interest rates go up, either because interest rates go up, which they're predicted to do next year, and a lot more in 2023 and a lot more in 2024, that could make interest rates rise, which means that your bond becomes less valuable, as well as creditworthiness. And in a debt world, creditworthiness is a real problem as well. So the long and the short of it is that bonds are not as safe as you might be led to believe. In a normal world, they are, not in a debt world. So what can you do about it? You always keep a percent equal to your age safe. And you always want to be diversified on your at-risk side. Now, since growth is killing value, we have been doing value replacements. As you can see, we've been doing it all year. And then you also have 4 hots. So whether you think it's clean energy, technology, biotechnology, crypto, silver, gold, cannabis, whatever you think is hot, you can put in the hot slices. So these are the average returns. And this is one of the reasons why you don't just jump all in or all out and say, okay, I'm not going to be in anything, I'm going to be in cash. It's because you do get a good return over time in stocks. So you don't want to jump in or all in or all out. If you are keeping a percent equal to your age safe and you're worried about things, just put a little more safe. Don't go completely all in or all out. Market timing doesn't work because you're always going to be late selling and you're going to be late buying. Does that make sense? So many people, when they did market timing and they sell low because they think that the markets are they sell at the low, at the bottom. And instead they should be buying a little more then. And then when markets get high, if they don't have their slices filled up, then they want to buy high. So that is the opposite of what really successful investing is about. And that is why the pie chart system is a buy low, sell high system on autopilot. You do need to rebalance it regularly, at least once a year, not really more than 3 times a year. So if your slices get too big, they're saying sell high. If your slices get too small, they're saying buy low. And it's taking the emotions out of it by putting it into the pie chart format. If you need help doing that, that's what my second opinions are all about. So you can call 310-430-2397 or email us at info@nataliepace.com if you're interested in a second opinion on your current plan. And we can look at the bonds, we can look at everything. So the bottom line is that right now, you definitely want to have a percent equal to your age safe. It looks like we're going to have a Santa rally. So we don't have our sample pie charts overweighted safe, but if you're nervous about all the things that are going on, overweight safe, we do have, by December 3rd, we have to have raised the debt ceiling again. And the closer we get to that deadline without it being done, it could be negative for stocks. So Apple is a positive. They're probably going to continue their buyback program. And if we raise the debt ceiling in time, that's a positive. Again, the closer we get to that deadline of December 2nd, the worse off that it is for stocks. So, and next year, the GDP growth is expected to temper. So it could be even under 4% next year for the US. This year, it should be at least 5.7% overall. It was 6.7% in the second quarter, and it was pretty good in the first quarter too. So again, the reason that you do have stocks is because stocks are the best game in town traditionally. And as you can see, gold has been underperforming, but it's really underperforming its 30-year average. I think that silver is a better idea than gold right now because silver is about half of its all-time high, whereas gold is very close to its all-time high. And usually they run in tandem. So let me show you real quickly what I mean. So if you want to have a slice of gold or silver, if I were you, I'd probably be a little more interested in silver. And again, here's the all-time high chart. You can see that it's currently at 23 and the all-time high was closer to 47. Whereas gold, the all-time high was just above 2,000 and it's about 1,850 right now. So as you can see, the GDP and the IMF is saying 5.7. The feds are saying 5.9% this year. That was revised down from June. Next year, they're expecting 3.8% GDP, and then in 2023, 2.5. You're never going to see the Federal Reserve Board projecting a recession. Never. Okay, it happens, and then they have to scramble. And a lot of times, even when it's happening, and we know it's happening, and stocks are plunging, they still try to say, oh, everything is okay, and they try to calm the thing. So the recessions don't get named until after they start happening. And they don't get named the end until after we're sure it's really ended. Again, if you wait for headlines, it's too late. That's why you have a balanced plan, and that's why you rebalance it regularly. And that's why you might consider overweighting safe next year, not this year. So again, all of this is taught at our 3-day investor educational retreats. The next one is online. It's February 11th through the 13th. Day 1 is nest egg strategies. Day 2 is how to get hot and how to avoid the bailouts or the problem areas like value. Day 3 all day long is what's safe and how to get safe. Now, that retreat is almost sold out, and the early bird pricing ends on Christmas Eve, December 24th. So if you are interested in making sure that you get the best price and that you get in before it gets sold out, I would strongly encourage you to register right away. So again, I'll give you our phone numbers and our email. It's 310-430-2397. The email is info@nataliepace.com. Also, I wanted to let you know a couple of things is that, look, email is kind of an old school way of reaching us or us reaching you. Please start following me on social media. If you're not on Twitter, then all you have to do is go to nataliepace.com. And I have my Twitter feed there. You can scroll through it and click on anything that you're interested in. If you're interested in what's going on with Moderna, if you're interested in any of these different articles and blogs, just scroll through and click on them. In fact, even for this video conference, I'll be putting it up on Twitter, so you'd be able to access it. You can also access our video recordings. Like I told you, we have a number of them from prior ones that you can access here. So what's safe in a debt world? My interview with the senior index analyst of the S&P 500, Howard Silverblatt, debt solutions, exit strategies, crypto information, and interview with the chief economist of the National Association of Realtors, etc. So again, that's youtube.com/Natalie Pace. And again, all of these links are at nataliepace.com. There's the YouTube link, there's Facebook, Twitter, Instagram, LinkedIn even, and how to email us. So again, if you really want to stay up to date on all of the blogs and all of the daily money tips, either visit nataliepace.com and scroll through the Twitter feed, or be sure that you're following me on Instagram is more the picture stuff, so there's sometimes even more sustainability stuff, but Twitter is more of the blogs. All right, so I'm going to go ahead and stop it here. Oh, actually, I want to show you a couple of report cards real quickly, because I did mention, hey, what's on sale if everything is too expensive, right? So here is a FANG stock report card, and we have changed it now since Meta Facebook is now Meta and Google is now Alphabet. There's a different acronym. Jim Cramer is calling it Maman. I'm calling it Xana Mad Max. So I'm going to be doing a stock report card on Xana Mad Max soon. And you'll get to see what all of those different acronyms mean. But for now, I wanted to show you what I mean about stocks are expensive. So the average price earnings ratio is 17. And as you can see here, Zoom's is crazy high. Again, this is from October 8th, so it's about a month old. But all of the price earnings ratios are super high. If the average is 17 and Netflix is trading at 67, that's pretty expensive for that stock. And anytime there's a disappointing earnings report, that's why it plunges. So that's kind of what happened with Disney today. It actually had pretty good year-over-year revenue growth. It didn't meet expectations, and because stocks are in general expensive, the stock plunged about 8%. So by comparison, we've had a lot of people talking trash about China, which is actually supposed to grow at 8% GDP, and their stocks are pretty much on sale. So you have Alibaba, which is growing at a faster rate than Amazon with better profit margins and at a much lower price earnings ratio. So you can see this even better when I put it on this one. So I put Alibaba and Amazon. Alibaba's price earnings ratio is 19, Amazon's is 58. And you can see that it's just really expensive. So US equities are really expensive and Chinese equities are much more affordable with better growth and better profit margins. So one of the things that you might think about doing, which we encourage at the retreat with your value replacements, is to use another country. Yeah, it's as simple as that. All right, guys, so I'm going to go ahead and stop the recording here. Just as one final thing, I am going to be going to Peru. Couple things in terms of economics. I'm going to be looking at why is it growing at 10%, what's going on in the country. We do know that it's the second largest producer of copper, and copper prices are at all-time highs. Chile is the largest producer of copper in the world, and copper prices are at all-time highs. So Chile is expected to grow 11% GDP, whereas Peru is 10. Both are pretty strong. Also, I'm going there because I do have the Earth Gratitude Project, and I'm thinking of writing a book about the power of 8 billion people to solve the climate crisis. And I'm going to be staying in the Sacred Valley to write that book. So you're probably going to see some pretty cool stuff on my Instagram feed. And, you know, I will definitely be communicating to you guys, but more on social, less on email. Okay. All right. I'm going to go ahead and stop it here. Okay. So it was a great conversation about cryptocurrency. So as you can see, let me pull up the chart again. You know, this is a sample one, right? And in the sample one, crypto was included. So if you're going to have crypto, consider it a hot slice. Like you could have one hot slice. If you want 2 hot slices, that's totally fine. But the thing about the pie chart and the regular rebalancing that's going to be very helpful to you is to be able to take profits at the high and buy back in at the low. Again, you don't have to exit cryptocurrency altogether. You don't have to say, okay, it's at 65 today, so I 65,000 for Bitcoin, so I'm going to sell it all. And then you freak out if it just drops a little bit and you don't have it, or you freak out if it goes up a little bit and you don't have any. It can be that if you have a slice and it becomes 2 or 3 slices, you trim it back to a slice, right? Now, in terms of the cryptocurrencies themselves, the interesting thing about that, it has a lot to do with almost what we were talking about with regard to silver and gold. Some of them are very high and some of them are not. So with Bitcoin, if you bought it today, you know, you were going to be getting it at having to pay 65,000 for it, and you're purchasing it very close to its all-time high, right? You could have purchased it at 32,000, and that was even just back in July. So the interesting thing is that if you'd sold it at 65 when it hit it in April, by July, you could have bought it back at 35,000. So again, it's kind of a plug for the efficacy of this pie chart system, is that when you have slices and you stuck them into a pie chart in a simple Excel file, when the slice becomes, you know, another slice, it's telling you sell high. And then if you've sold that extra slice of Bitcoin or whatever, you know, current crypto you have, and all of a sudden it goes down by half and your slice is now half a slice, it's saying buy low. So this system is going to help you, because what a lot of people don't realize about crypto is that it is not a buy and hold strategy. It's not yet being used as a currency. So what is happening with crypto is that every time it goes to its all-time high, the whales are moving in and you're seeing them sell, whereas Main Street is getting caught hold the bag. So if you look here, it says the typical hold time is 76 days. That's a little over 2 months. And most cryptocurrencies, their hold time is even less than that. So if you're buying and holding, then you are being taken advantage of by hedge funds. And that's the bottom line on that. Now, in terms of other cryptocurrencies, I, as someone who cares about the environment, Bitcoin and Ethereum are heavy users of energy, very much so. It requires a lot of energy to mine a Bitcoin. So I am a fan of some of the altcoins that do not require this. Now, Cardano would be one. And again, its high was closer to $3. So at least if you wanted to start adding in an altcoin, You're not buying it at an all-time high. You certainly aren't buying it at an all-time low either, because you could have bought it at 112 in July. But here is its high was right there about 292. So again, at least you're buying it lower. Dogecoin started out as a joke, but it's now an open source crypto with lower energy. So, that one is one that you could consider as well. Solana, sorry, is one that's lower energy, and it's already kind of hit its all-time high. So this is one where if you did go in, you kind of are buying high. So that's just a real brief primer on crypto, but it's hot because it's not diversified, but you could put in your own crypto fund in that slice. So you want to have a slice or two of crypto, and you want to use the rebalancing as a potential to help you to buy low and sell high. Again, it's not market timing, because you're not going to jump all in or all out. You're going to trim slices back. If you really believe in cryptocurrency over the long run, at least when you see it shoot the moon, take some profits. At least if you see it plunge, buy low. Okay. All right. Okay, so it was a really good question about the infrastructure bill. So the interesting thing is that, again, Wall Street is forward looking. So the feds already knew about the infrastructure bill when they were revising their projections for GDP growth next year and the year following. So the problem isn't that we aren't going to infuse capital into the economy. It's that we have this debt load and this debt hangover that weighs on the economy. We also have still high unemployment, and all of the unemployment that we have is not necessarily reflected in the unemployment rate, because a lot of people have just dropped out. So I believe look, the infrastructure bill is actually what will help the economy to grow, hopefully at the pace that the feds are predicting, rather than it being a big upside surprise that we haven't built in. That's my take on it. And again, that would be from the feds, observing the feds, listening to the feds, and looking more at the financial stability reports. The other problem, as we talked about, is that asset prices are at an all-time high. So you can see really strong companies with year-over-year growth, like whether it's Beyond Meat, a plant protein that is increasing faster than any other vertical in food, or Disney, which is a beloved brand and has great year-over-year sales growth, but missed earnings by a little bit, or projections by a little bit, and getting killed in the stock today. So the reason that these are getting killed in the stock is not because they're not doing well or won't do better even, or even if there's an infrastructure bill that will target certain industries. It's more that that's already overpriced in. This market is overpriced for whatever growth that we might throw at it. That is the bigger issue. It's over leveraged and it's overpriced. So I think you should factor those in. Now, the other problem is that traditional infrastructure companies are the ones that are the value companies that are the most over leveraged, the slowest growth, and the highest debt. So a lot of those companies, this infrastructure bill, rather than giving them this great growth, is actually going to keep them from imploding. So that's what I would say is real important about this, is be careful. Look, if we get the 3.8% GDP growth next year, that's still GDP growth. That's still a positive for the economy. The problem is that it's already overpriced into the stock prices. So be careful of that.